What are options? Does anybody know? An option can be broken down simply as a contract between two people. There's a person that sells the contract and collects a premium. Then there's someone who buys the contract and pays the premium. There's two sides of this contract, right? You have someone writing it, and then you have somebody buying it. So what's the purpose? Think of it as insurance. Whenever someone is writing a contract and collecting a premium, what's in the contract? The contract is giving a promise, just like insurance, to pay for a security at a set time, at a set price. The person who has the choice to execute the option, the person that's buying the option, the contract, doesn't have to execute that contract. And same thing with insurance. You pay a premium for a contract that says, hey, if something happens to my house, insurance company, you're going to pay, right? It's the same thing with options. But that's not all it is. People use it for many different reasons, good or bad. But it put in a nutshell, that's exactly what an option is. I'm someone who sells an option. I collect a premium, and then there's someone who buys the option and has the choice to file the claim, as you would in insurance. There's two different kinds of options. There's a call option and there's a put option. You say, why are there two? It depends on what kind of contract it is. There's a contract for someone to buy shares at a set price at a set time. That's the call. And then there's a contract for someone to sell stock at a set price at a set time. So now you're seeing that there's the option to buy, there's the option to sell. And that's depending on what the contract is. The contract lays it out simply as a call and a put. There is no other contract. You either buy shares with the contract or sell shares with the contract. There's four components to this contract. You have the underlying asset, which is the stock, whatever stock it might be. Could be Tesla, could be Palantir, could be DraftKings, whatever the stock is. You have the strike price. Are you doing this contract if price is at $17 and below, $18 and below, $17 and above, $18 and above? Where is the strike price on this option? The expiration date. What is the date that this option expires? Options only last so long, and they're set on predetermined weekly and monthly bases. And then also the option premium. How much is this contract worth right now? And it's the same thing with insurance premiums, right? How much are you willing to pay for your insurance? What's the lowest price, or what's the highest value? You know, you might be wanting to pay more in your premium because you're wanting more coverage on a certain stock. Maybe you live in Florida and insurance is much more expensive in Florida than it would be in maybe the middle of the state where there's no major weather, anything like that, right? So you're going to have different prices to pay for this contract. The premium will be different at different times. So those are the four things. You have the underlying asset, you have the strike price, you have the expiration date, and then you have the option premium. Are the contracts actually physical pieces of paper? Can you make them however you want? No. These contracts are set and predetermined, and all you are simply doing is making that contract on the software platform. The dates are in a list, the prices are already set based on the market. All these are predetermined. You're not actually physically writing out a contract. The contract is generated through the platform during your trading. So to you, you're just buying and selling. That's all you're seeing in the platform. So you can be a holder, you can be a seller, you can be both. So it's very dynamic, and it's not actually physical pieces of paper like you might expect. They call them contracts just because they are, in the legal sense, they are a contract, and they can be executed. It's legally binding. And so that's an important point to understand, is that whenever you engage in options, you're engaging in a legally binding contract that you are obligated to execute when someone wishes. If you're selling it, if you're buying it, you have the choice to execute that option or not execute it. Another very important point about options is that every contract is worth 100 shares. One contract can be a lot of money depending on what kind of stock you buy. If you buy a stock that's worth $10, then the worth of that contract is $1,000. If the stock is worth $100, then you're going to have to, it's worth $10,000. So you can see that depending on how much money you have, you're limited on what contracts you can be involved in and not be involved in. So it does require some money up front depending on what stocks you're interested in. So it's a very important point to understand how much money that you're getting involved whenever you're getting involved in contracts like this. So what do these options look like on a trading platform? Let's take a look.
All right, so we're in the TastyTrade platform. We have the trade tab activated. Tesla is the stock we're looking at. What we have here in the middle is called the options chain. Everything right here is collapsed, and every line represents the expiration date. So every expiration date is a Friday, and we can break down the contracts inside each expiration date. So you can see there, we have the same expiration date, December 29th, with all the different strike prices for this contract. So you can see that there's plenty of these contracts that you can engage in. There's the 29th, January 5th. They all have different contracts. This is what you see in the software. This is what you're going to see whenever you're trading these contracts and what you want to choose. You have the premiums, the bid and the ask are the buying and selling sides of each of these premiums, of each of these contracts. So if you wanted to sell, you would do the bid. If you were wanting to buy, then you would do the ask. So that's the value of the stock. And what you notice is the longer time frame that you give, the more that contract is worth. So prices will go up as you go further in time. So over here on the right side, you have the puts. And then over on the left, you have the calls. Again, what's a put? It gives someone the option to sell at a certain amount of time, right? With a certain expiration at a certain stock price. And then the call is the same thing, but it's buying. It's the option to buy stock at a certain strike price with a certain expiration date. And then the premium that you must pay to have that option shows up in the bid and the ask here in the software platform. So you can see when people say contracts, it's not actually a written piece of paper that you get in the mail. This is actually on the software, and it gives you all the options laid out, so you don't have to go through all that. Everything is laid out for you in the platform, and that's what the platform's for. It gives you that freedom. It gives you that ability to look at all the options that you have available quickly to make your decision, hopefully based on a strategy.
That'll do it for today. Please leave a comment down below if you have any questions about options. It is complex, but it is not impossible to figure out. Feel free to like and subscribe as well to follow along on how to trade options to understand more about how options work.